Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Jeff Rosenkranz, portfolio manager of the Shelton Tactical Credit Fund, to discuss managing a fixed income portfolio in the current environment and probability of a soft landing. Jeff, it's great to have you with us. Welcome to Trade Talks.
Thanks for having me. Great to be here.
You got it. Let's talk about being a fixed income PM in this environment. How have you experienced an environment like this in your career before? And what are the daily challenges this market environment imposes?
No doubt it's very challenging. Certainly there have been cycles in my career, recessions, stimulating the economy out of recessions. This one's definitely a little different. There really was no playbook for running fixed income portfolios during and coming out of a pandemic. And so that one, you're really trying to draw on similar, but certainly not the same types of historical precedents. But it's a challenge. And then certainly volatility is much more significant lately compared to historical norms. And so even liquid U.S. Treasury markets are much more liquid than much more volatile, than they used to be. And so it's just a very different challenge.
Let's talk about some of the data for a moment. The last GDP release showed strong growth for the U.S. economy, and the Fed just held rates steady at least until December. What is their course of action at the December meeting? And is this market pricing in more rate hikes?
The market's assigning a very small probability to one more rate hike in December. We think there likely will not be any more, but the Fed is going to keep telling us that they might raise rates until they're absolutely sure that they're done. They don't want the rates market to get ahead of itself and to get ahead of the Fed. This significant tightening of financial conditions that we've experienced, especially with the long end of the yield curve rising a lot, they don't want that to reverse itself too quickly and loosen things up again, because really it was starting to bite and starting to have its intended effect on the economy and slowing things down. So likely not to be another hike, but we'll see. There's a significant amount of additional economic data between now and the December meeting. But as it looks right now, it's a low probability that they'll hike again in December.
What are leading indicators telling you and the rest of the Shelton fixed income team? Is a soft landing still possible, or is that a pipe dream at this point?
Well, the leading indicators are continuing to show a slowing in the economy, and we're almost getting to the point where even the concurrent indicators are starting to catch up as well. So hours worked, which tends to lead things like unemployment, is certainly showing us that the economy, the labor market, is finally starting to cool. So really what that's telling us is there's not going to be a need for additional rate hikes, and the Fed can just sit back, make sure we're on a nice glide path to a slowing economy. Now, whether or not that's a soft landing or a hard landing, we lean a little bit towards a bumpier one because there's so much of this accumulated rate hikes that hasn't really been felt throughout a lot of the economy. If you haven't had to refinance a mortgage or a car loan yet, or large consumer durable goods, and only a small percentage of borrowers have had to so far, you really haven't felt the full effect. So there's a significant amount of additional tightening that's going to work its way through the system and slow things down. And it's really with the lagged effects of these rate hikes, you don't really know that things are slowing until it's really too late. And so we think the Fed will overcorrect and things will, again, take a bumpier landing. That's where we see things.
Let's wrap it up here and talk about T yields for a moment. Yields are still increasing, and investors can get attractive yields at a much lower risk than corporate or even munis. Do you see an inflection point on the horizon for people to start moving out of T-bills and back into corporate debt?
Absolutely. And they if they haven't yet, they certainly should be starting to move out the yield curve and get some duration, maybe not 100% of your portfolios, because that 5.25 or better yield on a T-bill or a money market is certainly enticing. But as we look forward 6 to 12 months from now, people are going to look back and rue their inability to lock in rates for a longer period of time. It's really a golden era or a once in a cycle opportunity to lock in really attractive yields on high quality fixed income, treasuries, high quality corporates, et cetera.
All right, Jeff, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
My pleasure. Thanks for having me.